I guess one question that many ask themselves is how to get on your radar screen.
I understand from a manager perspective that it can feel a bit frustrating not being able to reach me, but I do follow a lot of managers and I do have a lot of managers on my radar, and also that things change. So even though I'm not actively looking at a manager-specific strategy today, doesn't mean that it won't be interesting in a 6 months' time or in a year. So my advice is to be patient and not give up, because things change, both strategy-wise or objective-wise in the hedge fund portfolios. I explained before that a few years ago I had a CTA portfolio, and now I have a completely different hedge fund portfolio.
Welcome to the Allocator's Corner podcast, a podcast exploring the institutional asset management trends in the Nordics. My name is Jonathan Ferlid, and I will guide you through conversations with some of the most high-profile asset allocators, fund managers, and asset management industry trend spotters in the region. In this episode, I had the opportunity to sit down with Helen Idenstedt, who is portfolio manager alternative investments at the first Swedish national pension fund, AP1. The role of the portfolio that Helen runs is to serve as a diversified source of alpha within the broader AP1 mandate. A mandate that currently has around 350 billion Swedish krona in assets under management. During the session, we discussed how to manage so-called idiosyncratic risk using alternative investment strategies, the process behind our manager selection, what the portfolio looks like today, and how ESG has received increased attention in the alternative space as of late. We also had a chance to discuss a new mandate linked to private debt strategies that Helen has just started allocating assets to. Please enjoy my conversation with Helen Idenstedt. So today I'm here with Helen Idenstedt, who is a portfolio manager within alternative investments at AP1, or the first national Swedish pension fund. Welcome to the show, Helen.
Thank you, Jonathan, and thanks for having me here.
I wanted to start just giving a bit of a brief introduction of who you are and how you ended up at AP1.
So I've been working in the hedge fund industry for, I guess it's almost 14 years now, evaluating hedge fund managers. And I started at a local firm or a Swedish firm here in Stockholm that focused on CTAs and global macro managers many years ago. At AP1, I worked for the last 4 years, and I'm responsible for the hedge fund portfolio, or the idiosyncratic alternative investment portfolio that we call it. And there I cover most hedge fund strategies that are in the universe, but I also have started to build a new portfolio within private credits.
Okay, and that's very recent, that new one.
Yeah.
So it's for this year, or is it?
Yeah, so last year, or the beginning of this year, we had a change in the AP law that we are regulated by, which we've had a cap or a limitation on how much we can do in private markets, or I would say illiquid strategies. So that cap disappeared, and as a result, within my mandate, not only looking for uncorrelated strategies within the hedge fund universe, I could also explore if I could find interesting strategies within private credit. So it's a new asset class for us at the fund, or I think have made a small allocation historically, but no substantial allocations. So this mandate, or my mandate, broadened beginning of the year.
Okay. Just by means of background, if you were to describe the overall mandate of AP1 and how your portfolio fit into that mandate, so to speak.
Yeah, so one could say that I fit within the alternative investment bucket. So we have a pretty large allocation to alternatives at AP1 that includes real estate, infrastructure, private equity, and hedge funds. So I think it's around 25% or around that size. And we have had allocation to hedge funds since 2012 at AP1. So it's been, when we started to allocate to hedge funds, we wanted to mitigate the equity risk. So 35% of the fund is allocated to equities. So it's the largest risk we have.
Yeah.
So in the beginning, we had a portfolio that was allocated to CTAs, global macro managers, very heavily tilted to trend following strategies. As we have all seen, there have been a lot of evolution or changes in the industry, in the hedge fund industry. So many of those strategies that we would define as alpha strategies have to some extent become more beta strategies. And we as a fund, of course, have seen this and learned from it. So we decided to internalize trend following strategies about 2 years ago. Mm-hmm. So now we have an internal quant team who is responsible for that implementation. So we still think it's a strategy that adds value to the overall fund, but not in a hedge fund format.
Yeah.
So this result...
So you have no allocations to CTAs at this point, externally, so to speak?
No, so it's just internally managed.
Yeah.
Or CTAs that are highly correlated to the sort of trend index, I would say. I do have CTAs, but not a typical trend following type.
Yeah.
So the hedge fund portfolio that I manage had a change of objective. So from having this more protective type of characteristic, we now have a hedge fund portfolio that is more of diversifying in nature or and more absolute return type of hedge fund strategy. So the idea is to find uncorrelated or idiosyncratic, as we call it, hence the name, idiosyncratic alternative investments, and build a portfolio that could add diversification to the fund and things that we can't do ourselves or things that we can do cheaper or replicate. Strategies that have low correlation to both traditional as well as alternative risk premia. So it's going from only having a small piece of the hedge fund universe, CTAs and global macro managers. I'm now covering more or less the whole liquid hedge fund space or universe. Okay.
And do you have like an overall return target for your specific mandate, or is it more that you need to be diversified and diversify the whole portfolio rather than you having a specific return target to?
So the return target that I have is a LIBOR plus 4% return target, and the risk profile that is similar to that, sort of around 3 to 7%. And then I also have a cap on how much beta exposure or beta to MSCI. It should be below 0.4 over a period of time. Yeah. And then low correlation to, as I said, both traditional and alternative risk premia. So there are some caps or limitations on the mandate.
And the overall mandate for AP1, I think, is around 350 billion SEK at this point. How much is your part of that? Is that, you mentioned 25% as being alternatives, but your specific mandate is rather around 5%.
Yeah, so it's 4% allocation to these liquid hedge fund strategies, so the idiosyncratic bucket. And then I'm building this private credit portfolio, which is an additional 1 to 2% allocation. Yeah, yeah.
And in terms of your particular mandate, how is that structured around strategies and managers at this point? How many managers do you have in that portfolio, and what strategies are in there?
So the portfolio consists of 12 managers today. Did actually redeem from 2 managers during the year, and it's strategies ranging from long-short equity. It's event-driven strategies. I have stat arb, relative value. I also have a few credit strategies. And also both, I have some global macro strategies as well.
And is it all systematic, or is it a mixture?
No, so it's been a little bit of a change during the year, but now I have 4 strategies that would be systematic and 8 discretionary. But the systematic managers do take, I think, 40% of the risk, although the capital is around 30% allocated to them.
Mm.
So,
and in terms of the investment process and how you how you do the manager selection, how is that done within your organization?
So a big part of my work is to meet with different managers. I have a lot of people coming and see me in Stockholm, and I also travel a lot to meet managers. I do this portfolio together with an advisor. So Man FRM is part of Man Group. They advise me on this portfolio. So we together come up with a short list, I would say, that constantly developing over time. Have discussions with them and trying to add 1 or 2 strategies, maybe redeem from 1 each year. So it's a constant
So you do the selection in talking to this advisor and more or less having that as a speaking partner in this process?
Yeah, I would say on the hedge fund side, I have quite a long experience myself evaluating managers. So then it's more of a joint discussion on interesting managers that they've seen and interesting managers that I've seen. The private credit portfolio that I'm building this is a fairly new space to me. So I would say that I rely more on the advisor to filter and kind of narrowing the universe down for me. But at the end of the day, it's my decision which manager to select.
And all of these managers need to go through an RFP and the procurement process, or how does the...
No, so there is no selection of each manager via this type of procurement process. Rather, we had a few years ago, when we were searching for a new advisor, that process was a procurement process.
Okay.
So I would say that the structure is fixed, but then the setup enables us to select managers discretionally.
Okay.
So it's not each manager that goes to as a procurement process.
Okay.
As for other mandates that we have at AP1.
Yeah, and you say that you meet with a lot of managers, but do you also use databases and similar for scanning the universe, so to speak, in terms of the search for new strategies and managers? And
I wouldn't say that I do that to a large extent, no. So I guess referring to the question earlier, it feels like I've built up a pretty good network over the years in the hedge fund industry, where, of course, I speak to cup intro teams and I speak to other peers and I speak to my advisor. Managers, of course, approach me directly. I approach managers, go to conferences. So it's more that I build up that network myself. But then when it comes to the private credit portfolio, I would say that I have had a lot of help from my advisor in the sense that there aren't as publicly available databases in the same sense as in the liquid hedge fund space. And that's my experience, at least. So you've had to gather that data yourself over time, and they have that information so that you can compare vintages and different managers over time, because that's completely different exercise than comparing a hedge fund strategy that's been live for 10 years than comparing different vintages in these different private credit strategies.
But does that mean that you typically end up with the big names in the industry, or is it even possible to allocate to smaller managers in this context?
Yeah, I would say I don't have so many of the really large. I don't think I even have any of the largest managers. I would say what is interesting when trying to find idiosyncratic strategies, one thing could be to find a sometimes it's capacity constraint, right? So then you can't be too big. So that's one way of trying to find these different return streams. I would say that I usually don't tend to go with the larger ones. There are no restriction on my mandate that I have to have a certain length of track record, or that I can't do emerging managers. But then, of course, at the end of the day, I do allocate quite a large chunk of money each time. So, you can't be too small. But no, I would say that the managers that I have in the portfolio today would not be on the sort of largest top lists in the hedge fund world.
And going back to your definition of idiosyncratic strategies, because that is a word that I don't hear other AP funds talk about too much. It's rather you that has defined that particular way of expressing your strategy. What do you put into that definition of idiosyncratic?
Yeah, I think it's if you speak to peers around or other investors around the world, I guess almost everyone is searching for uncorrelated idiosyncratic strategies. I think the ability we have at AP1 to internalize and do certain strategies cheaper enables us to be able to pay for things that we can't do ourselves and that actually are unique and different. I think that diversification in general is something that we really need at the fund level if you look at the total fund. So if we can add that to the portfolio, it's very valuable to the fund to find this type of uncorrelated return streams.
And a hot topic has been ESG or sustainability over the last years. And when I talk to some of the managers, that they say that, it's mostly linked to equity strategies, that this ESG work that has been done over the years. What is your experience from the alternative side? Is that starting to happen also in that space, the sustainability thinking and integration in strategies?
I think I would start with saying that for AP1, we of course want to be responsible investors in all our investments, and we have very high ambitions when it comes to building a portfolio that, of course, meet our return target, but we also want to do that in a sustainable and responsible way. I think it's a great advantage to work at an asset manager that I do that have this long-term investment horizon, and also the size and the capital that we have, so we can actually engage. And that is, in the end, to be able to really make a change. And we do a lot of things, especially in our equity book. But having said that, there are, of course, asset classes and strategies within hedge funds. It can be more difficult to apply ESG factors, but there are certain strategies that it totally makes sense to incorporate ESG factors into your investment process. If you have a longer term investment horizon, if you evaluate equities or credits, it does make sense. And I really think that something has really changed in the way that manager in general do address this topic more often. Sometimes it's greenwashing and marketing, but there are a lot of managers who are really trying to understand if it can be of value in their process as well. So I think the best way going forward that I think is to have these dialogues together with managers and investors to find out and figure out what we should do when it comes to incorporating ESG into the investment strategies, but also where will it have most effect, and focus on sort of being very pragmatic about it when it comes to hedge funds.
But it's still that equity strategies and to some extent fixed income strategies are, the most applicable in that sense that...
Yeah, so when it comes to this more systematic, shorter term, either if you have derivatives that you trade, for example, it's not really makes sense to talk about ESG in the same way as for the equity and credit strategies.
But talking about the new portfolio, the private debt one, there you really have the choice to actually go and find managers or strategies that actually have a great impact on the end target of the investment, so to speak. Is that something you incorporate when you look at credit, to actually have a sustainability filter on your investments to make sure that they are actually, well, they could make a difference investing into different projects that are linked to sustainable purposes?
There's no strategy that we looked at that has a sole focus on sort of impact investing in the credit space so far. I would say so. We have.
I was more thinking about like projects linked to wind power or similar.
We do. There are some managers out there who do that. We haven't. We haven't allocated to that type of strategy yet, but. When we have discussions with the managers in the credit space today, we want them to avoid certain sectors, so like oil, sand, nuclear weapons, tobacco, things like that we feel are not perhaps responsible investments. We do the same thing when we talk about the public market, so we have an exclusion list that managers need to restrict from trading in certain companies. But I feel that the managers that I have met within the private credit space do have, at a various degree, of course, but they do talk about ESG. They usually have ESG policies. They incorporate these type of factors when they evaluate the credit, in addition to the financial factors. So, because it really makes sense if you're going to loan, for example, you're going to give a loan to a company that you don't think is going to still be around in 2 years' time due to they are, I don't know, worst in class in their sector using water, for example. So it makes a lot of sense to look at these factors. So it feels like it's in this portfolio. I think we can. It's going to be easier to have a more general ESG policy than for the very diversified hedge fund space.
But essentially, you work with an exclusion list where you say that I can't invest in these particular sectors, and then you go from there, or how do you work on scanning for ESG factors? Do you do that with your advisor on the alternative side, or how does that look?
So we don't scan for ESG factors in the current hedge fund portfolio, but we do have on our systematic equity strategies that we have internally at AP1, we have that type of screening.
And you're using external sources for that scanning. And in terms of the portfolio you run, we can go into the new mandate a bit deeper later on. But for the current mandate, what are you looking for currently, and for what reason?
I would say I can perhaps talk a little bit about sort of the portfolio construction. We spent and do spend a lot of time on portfolio construction. So trying to find these unique orthogonal strategies that are unique not only within the hedge fund portfolio but also compared to the rest of the fund. It's an exercise where I guess it's both bottom up and top down. So bottom up, you're trying to find these skilled managers that you think are able to be successful and even in the future. So have a solid process and being able to adapt to market changes. So it's really a bet on individual managers. But then top down, of course, you need to have some sort of idea of how you want to. There are different hedge fund strategies who have different risk premia. So it's some sort of combinations simultaneously that you do this exercise. But it's also important to look at how these strategies then correlate in market stress. So they tend to be uncorrelated over time when, everything is pretty much fine. But then strategies that you wouldn't necessarily think are correlated do actually correlate. So this type of tail dependence could be interesting to look at in a portfolio construction exercise. And also the individual volatility of a strategy. So when you're trying to build this type of portfolio, it's very difficult, or it's very easy to end up with the total portfolio realizing a very low volatility. So that is also important. Right now, I think I've been, for example, looking at discretionary macro managers. It's a strategy that I or that in general had a little bit of trouble the last couple of years. So they haven't been able to find or take enough risk or find opportunities. But it should be a strategy that could potentially be very good if we would see increased volatility going forward, which I guess at least is a pretty viable option. Then an area that I really are very interested in. So I don't go around and define myself as a quant, even though I have a math major, but there is this trend of a lot of, or not a lot, but there are a trend that we're seeing managers applying machine learning to financial markets. And that really speaks to me. And I think that's a really interesting area. And I think it's going to be interesting in asset management in general. So that is an area where I'm pretty active in meeting managers and trying to find talent.
And looking back over the last 2 years or so, what has been working in your portfolio and what has not been working? Because it's been a very good period for equities overall. That might be the environment where your strategies are shining, so to speak. But within your portfolio, what has worked and what has not worked?
So it's been alive for 18 months, so it's a pretty short period of time, I would say. And I'm going to try to answer this question, I guess, as humble as I can. So actually, I would say that it hasn't been anything that hasn't worked okay. So of course, there are always strategies that do a bit poorly in periods of time, but it hasn't been anything out of what's expected of the strategies. I'm pretty proud of the way that the strategy has worked so far. We have, I think year to date, it's up 6.8%, realizing perhaps a little bit too low volatility since inception. So that's something we can work with. But it has tended to be pretty resilient when we have seen stress in the market, and even though it's been able to perform in a beta type of market. So it's more that there are no sort of one strategy that really hasn't worked. I wouldn't say that, no.
And in terms of the strategies that you've been internalizing or that you're replicating in-house, what is your experience from that? Is that working well? Is that, well, by now you can compare it to external managers and how they do. What is your experience overall from internalizing?
And the experience has been actually very positive. So, of course, so we are in line with sort of benchmarks. So happy about the implementation. Then I think the quant team perhaps it's hard work.
Yeah.
So and it's a constant. You need to constantly evolve as well and develop your strategy. So it takes a lot of time and effort instead of giving money.
And how many people do you have on that side?
So we have 5 people in the quant team. now. So no, but that's been a positive experience.
Well, looking ahead, what do you think about? You mentioned increased volatility as one risk or one potential option going forward. Do you have that sort of strategies that are only in there to capture volatility as a phenomena, or volatility spikes?
No, not really. But there are quite a lot of the strategies that thrive in more volatile environment, I would say. But no specific sort of volatility spike targeting strategies.
And going back to that new mandate that you've started to allocating to, the private debt one. Can you talk a bit about, more in detail about that mandate and what you're looking to do in the coming year or so?
Sure. So the private credit portfolio is a portfolio it's going to be a combination of both yield-oriented and return-maximizing credit strategies. So we have this first change of the law that enable us to do more in the private market space, but then we still have a regulatory a regulation that enables us to do direct lending. This is proposed to change next year in May 2020. So given that will happen, we will have a very diversified portfolio ranging from both direct lending strategies to structured credit, stressed, specialty finance. So it will be a portfolio that we will build over 2 to 3 years. I did my first investment last month and hopefully one more this month.
Okay.
And it's a little bit of a core satellite type of approach. So we will have 4 or 5 larger managers that are more sort of multi-strat or larger credit houses that are able to more opportunistically allocate between different strategies. And then add some, I don't know, maybe some more niche or narrower type of strategies to that. Around 8 to 12 managers in total. And I mean, it's a really different exercise from building this liquid hedge fund portfolio. So where you can more or less do a due diligence on a manager in the hedge fund space, and then you choose to allocate, and that's that. But here, these are drawdown structures. They have a life of 4 to 8 years, something. The manager needs to be in the market with a certain strategy. So even if you find a manager that you like, they might not have a product to offer you. So it's a very different exercise in building the portfolio.
But in terms of the change in regulation, is that linked to the liquidity you're allowed to have in your books? I mean, in terms of private debt, I guess you need to lock up money for a number of years. Is that what the regulation change is about? I mean, the link to liquidity of
yeah. So the first change of the regulation was linked to that. So we were only able to do 5% in illiquid strategies or private markets. You tend to be illiquid, and we have allocated that to the private equity space. But now that we have an increased limit of what we can do in illiquid structures, we then thought that we wanted to explore this area as well. But then, of course, you have to look at the overall fund. How much do you want in illiquid strategies? Given that where we are in the cycle, you might want to be conscious of how much you put into illiquid strategies.
So your focus going into next year will be on this private debt portfolio primarily, and then, or looking at your team, are you alone in your team? I mean, on your end and talking to this advisor, or are you several people looking at different things?
So at AP1, it's just me.
Yeah, okay.
So I'm covering hedge fund strategies as well as private credit. And yes, the focus will be a lot on the private credit portfolio next year. But as I said, I have redeemed from 2 managers in the hedge fund portfolio this year, so it's a constant work on that portfolio as well. I need to have some additions there, but the private credit portfolio is just started to build up, and yes, I need to focus.
And what do you hope to get from that portfolio? I mean, is it more resilience, or is it? What do you have as a return? Is it a similar return target for that portfolio as for the alternatives mandate?
So the portfolio sits within the mandate that I described, having a LIBOR plus 4% return target. So the idea is that it should help to achieve that goal by finding new uncorrelated sources of return or asset classes that could add diversification, but the portfolio itself have a higher return target than I would expect from the hedge fund strategies. So these is more around 8 to 12% return type of strategies.
And I guess one question that many ask themselves is how to get on your radar screen, and how you work with this advisor that you have. Is that a systematic process that you have, that you continuously talk to them, and or how is the interaction going?
So it's very, very difficult to get on my attention, unfortunately, and the reason for that is mainly due to the fact that I'm all alone working on this at AP1, and I do get a fair amount of managers approaching me each week and trying to get my time and attention. But as I said before, working very closely to my advisor, one way to get on my radar screen can be to get their attention. They have a much larger team that covers hedge fund strategies with strategy heads ranging from long-short equity to quant and all the strategies. So they can spend a lot more time than I can on screening the universe of strategies. And they also have more time meeting and follow up on new managers and existing managers. So that is one tip that I have.
And these teams, they are based in London and New York.
Yeah, they are based in London and New York. And then, so my work and the process that we have together is that in addition to that, I'm constantly speaking to different people at FRM. We are also having from time to time specific projects where we want to evaluate or look to add, for example, a long-short equity manager. And then we have a specific projects where we meet very focused a certain amount of managers and do due diligence and hopefully get an allocation. What I would say is that it's I understand from a manager perspective that it can be feel a bit frustrating not being able to reach me, but I do follow a lot of managers, of course, and I do have a lot of managers on my radar, and also that things change. So even though I'm not actively looking at a manager-specific strategy today, doesn't mean that it won't be interesting in a 6 months' time or in a year. So my advice is to be patient and not give up, because things change, both strategy-wise or objective-wise in the hedge fund portfolios. I explained before that a few years ago I had a CTA portfolio, and now I have a completely different hedge fund portfolio.
But would you say that you do most of the meetings, or is the advisor doing most of the meetings?
Yeah, they do more meetings, but then again, I do a lot of meetings. So it's like they have a much broader coverage, I would say, than I am capable of, but resource-wise. But then I'm always, when we're getting to have narrowing down a short list, I'm very involved in meeting managers and doing my own investment due diligence, and that is separate from the one that my advisor do. So at the end of the day, I'm the one who's selecting the manager, so I need to be comfortable with the analysis myself.
Well, Helen, thank you very much for coming here today, and good luck with your private debt portfolio.
Thank you. I would need that, and thank you for having me.
Thank you.